The disaster in Japan and uprisings in the Middle East causing big moves in the markets worldwide. Today, stocks are gaining after Libya declared a ceasefire this morning. Tobias Levkovich, chief U.S. equity strategist for Citigroup, is here to tell us whether these are short-term moves or whether there's something else. Tobias, good to have you on set with us.
It's good to be here.
How do you begin to model for this kind of level of geopolitical risk these days?
You don't really model in. I mean, this stuff gets caught up in equity risk premiums. It's been, certainly on the Middle East, North Africa side, this has been around for, now about 2 months. I think the market has been focused on it. Oil prices more specifically get affected by potential production disruptions. On the Japan thing, it's obviously horrible and tragic, yet it's probably not disruptive to global GDP. I mean, about 5–6% of the prefectures of Japan were hit, not the entire country. Even if you lost that entire production within the country, you wouldn't lose 95% of Japan's GDP.
Yeah, so, it is such an inherently globalized financial system.
Right.
It's hard to compare what's happening in Japan to any kind of natural disaster that's played out there in the past. I mean, is it more along the lines of a 9/11 type event? Because
we'd say it's more in line, like the Kobe earthquake that they suffered before.
Except
Katrina.
There wasn't a tsunami. There wasn't
we had the tsunami in
disaster.
Thailand that was pretty devastating as well. So we can look at discrete local events. I think what's unique about this one, actually 3 different unique elements. One, bigger industrial base, and there are some modest, but there are some supply disruptions where you've had facilities shut down that are, core suppliers of a particular, input somewhere else, an auto part, a transmission, a computer chip, things like that. There are alternatives, but they won't come on immediately, so there'll be modest supply disruption. The second thing would be that you lose the or rather not you lose, you have that interconnectivity of the financial markets that you identified, things like repatriation of assets that are overseas needed for a rebuild. So it impacts maybe selling somewhere else, as well as currency shifts. And to a degree, G7's come in now to address the currency aspect.
They were concerned enough to intervene here.
Well, as it's a highly export-oriented economy. As the Japanese yen goes up, it really hurts the competitiveness well beyond the impact of the disaster. And then the third one has to do with raising the issue about, was there going to be a core meltdown, and if that was the case, it was far, far more severe than, and I don't want to minimize what happened, by saying more severe, but it could be even further disruptive. And we got a lot of news the last couple of days coming out from EU, from the U.S. government, even suggesting that it was far worse than we were thinking prior to it.
Right, the fear of what we don't know. You point to credit quality in the United States as improving. This week, though, we did see global company bond sales tumble to the lowest level of the year. Is that just a weak event?
I think it's a weak event. We don't actually look at the corporate bond market. We actually look at the Bank Lending Standards Survey from the Federal Reserve Board. It tends to lead bond markets, which is kind of interesting, not the other way around. And usually when those credit conditions are eased, about 9 months later, we see the impact in the economy through GDP, industrial production, capital spending, and all that's actually been moving very, very well. So at least through the end of this year, it does look like credit quality and credit conditions are supportive of economic growth. Beyond that, we don't really get that visibility.
How much attention are you paying to this Federal Reserve word being handed down? Go ahead. You can pay out dividends. You can go ahead with stock buybacks. Is that going to have an impact on the markets?
I think over the long term, dividends are a huge part of the returns that people have forgotten about. If you look over the past 100 years, half of the return for stocks came from dividends. But that was when dividends were 5%, not under 2%. So we can't, use the same kind of numbers. I think companies over time will raise dividends. I think certainly an aging baby boomer would like to get some more dividend income and not just appreciation.
Cisco do it today, but then you say, oh, is it because they're not growing?
Well, I think that's the concern of a lot of companies, is that they might send the signal we're not growing.
Right.
When you're generating excessive amount of cash flow, you probably can't find those 30% return projects anyway.
Tobias, it's always great to talk to you. Thanks for coming in.